Well, good evening and welcome to this live stream event on the 20th of October 2020. I'm Martin North from Digital Finance Analytics. Thanks for spending some time with me today, and I really am pleased that you've decided to come and spend a little bit of your evening with me on looking at all of my information and hopefully having some interesting conversations too. As normal, we'll run the show pretty much to sequence insofar that what we start with is just a little bit of this introduction, so we get people on the same page. Once we've done that, we can then move through the house rules quickly, talk about our models, look at some key slides. That's going to be very important today. There's some really important stuff that's come out over the last couple of days, which I want to go through. And then there'll be questions and answers, lots of time for your questions, and hopefully I'll be able to answer them. What I will say is that at this early part of the show, I'm not going to be looking at the chat particularly strongly. So if you've got a particular question, hold on to it, ask me a bit later, and I'll let you know when it's a good time to ask questions. The sign-off will be around 9:30, give or take, Sydney time. May run on a little if there's a very important conversation to be had, and maybe a bit shorter if we run out of things to talk about, but that's typically where we get to. So in terms of house rules, I always have to say this, I'm not providing a financial advice. I'm not the financial advisor. I'm just talking about my data. And if you need financial advice, go find a financial advisor. I don't know your personal circumstances, so don't take any of this as financial advice, please. Secondly, do play nice in the chat room. We are being moderated, and no racial slurs, please. This is as of the 20th of October 2020, so down the years, if you're watching this later, hello from 2025, if that's where you are watching this now, you'll know whether I was right or whether I was wrong. And if you want to get my attention, use @Walk the World. There's always loads of things going on the chat. One of the things I really enjoy about these sessions is seeing all the banter going on. But if you want me to respond specifically, do use @Walk the World. I've also enabled Super Chat, and that just means that if you want to make sure your question gets to the top of the list, you can use Super Chat to do that. Or if you want to make a donation to help DFA cover some of the costs of what we do, that is also available too. Ron, I appreciate your contribution already. It's greatly appreciated. Thank you for that. And so just to start the show properly, let me just explain a little bit about what we do and how we do it for those who've not been here before. We survey households all the time, put lots of other information together too, job keeper, job seeker information, house buying and selling trends, bunch of stuff into our core market model. That core market model then allows us to analyze what's going on, and that then supports the stuff we do on the channel. It also supports work we do for individual clients and a lot of other things too. And the core market model has at its heart a survey of households, 52,000 at any one time, updated literally today, the latest data coming today. Now, we overlay the household segments, and that allows us to slice and dice by location, different types of households, and many other indicators too. It's a Rubik's Cube, as I often say, and that allows us then to not only look at what's going on, but also put some scenarios together, and those scenarios, which we'll touch on briefly later, helps us think about what may happen down the track. Now, with any scenarios, it's not necessarily accurate, it's just an indication of different potential futures, but it helps to explore those because it means that we can look at different elements that may impact what's going on. And we also can look at home prices based on mortgage stress, the price trajectory information, the buying and selling intentions, migration data, and the economic data. That goes into the core market model and through our scenarios, and that means we can then look at a postcode level, a region, state, and all Australian level. And indeed, we can also look at an individual house price for a postcode as well. And that's quite significant given what's going on at the moment. There are lots of variables to talk about. So without further ado, let's move into the RBA minutes. This is a very important conversation about the minutes because essentially the minutes today confirmed they are going to target the cash rate and the 3-year bond rate definitely towards zero, but not necessarily going negative. And they're going to do it by buying government bonds out along the curve. This is significant, important, and it really shows that the Reserve Bank is going to exercise some muscles. The question is how effective will those muscles be? That will come, I guess, later. It's going to be very significant, larger balance sheet, and they also make the point that other central banks have actually expanded their balance sheets more, and that has had an impact on the Australian dollar exchange rate. Obviously, they want the exchange rate lower, so that's one of the reasons why they're going to be buying more bonds. And they're looking to lower the Aussie dollar through the impact of its domestic bonds, both in terms of purchase and liquidity and interest rates. But it's not really currency manipulation. For example, if they started buying foreign bonds, it's important to understand that. But nevertheless, they hope to see a positive impact on the exchange rate. We'll see whether that works. Remember, we're around 70 at the moment, 71, 72. I think the Reserve Bank would prefer to see it at 50, but who knows. And they're hoping that as the economy opens up, this will give more traction, because a further easing, they say, will reduce financial stability risks by strengthening the economy and private sector balance sheets. Well, that's debatable. More debt? Really? More debt making things even better? I'm not sure about that. The board agreed to place more weight on actual, not forecast inflation in its decision-making. That's a bit like the Fed's recent move as well. So probably expect the rates to stay lower for longer while inflation is tried to brought through. I think it's doubtful whether inflation will come through, of course. That's a big question for later. And they'd like to see progress towards full employment before considering an increase in the cash rate. So rates are lower for longer. In fact, rates will be low probably for at least 3 to 5 years, in my view. And so you can expect on Melbourne Cup Day, the board to cut the cash rate and to target the 3-year bond rate, and also the rate on term funding facilities from 0.25 to 0.1%. And in addition, it will reduce the rates on surplus exchange and settlement account balances. That's what the banks have at the RBA, right the way down to 0.01. And that's all trying to force the banks to lend more, to lend more, to lend more. That's what this is all about. And the board will probably announce the intention to purchase bonds issued by both the Australian government and semi-government authorities, probably in the 5 to 10 year maturity range. I don't expect, though, to see a specific quantum quoted. I think they want to leave that flexibility. So this is a big deal. This is further confirmation of driving rates ever lower, but it's the same old, same old. It's repeating this previous recipe, expecting a different outcome. Probably won't get one. Now, also today, we had Christopher Kent talking about the stance of monetary policy in a world of numerous tools. And essentially, he was arguing that the Reserve Bank has now a broader range of tools, particularly the things we've just touched on. And he compared and contrasted what happened with the global financial crisis. Particularly there, it was short-term liquidity. Today, it's a much longer-term strategy, particularly via the TFF facility, the term funding facility, as well as government bonds. And so they're claiming that they've got all these extra tools available. The question is, have they really? Well, we'll see, I guess. But interesting, the cash rate was much larger during the GFC at 400 basis points compared to a reduction of 50 basis points this year. In other words, we are so close to zero bounds, they can't pull the cash rate and much lower, which means they have to find other tools. And his suggestion was that the way to look at this was on the Reserve Bank's balance sheet. This is, he says, the way to understand what's going on. And you can see there that the total assets as a percentage of GDP is significantly up at the RBA. And the mix has been changed as well. So you can see there the government bond purchases way up, the reverse repo being squeezed slightly, and the term funding facility now beginning to take off, and that will expand and expand. And interestingly, there was also an argument put up by the Financial Review that the RBA is not fazed by the prospect of rising house prices. Now, of course, the Fin Review is very much the banker's rag, as it were, so not surprising they're talking this up. But essentially, the argument is that easing of monetary policy can help private sector balance sheets and lessen the number of problem loans. Well, maybe that's true, maybe it won't. So reduce financial stability. And also it provides further support for housing prices, even as the bank progressively weans people off their loan repayment deferrals. Well, I wonder about that. Robust house prices, they said, boosts overall financial stability because it means Australian banks will probably suffer fewer losses from home loan defaults. And they don't seem too concerned about the possibility of prices rising too sharply. And, by the way, there are structural changes unleashed in the market which will probably keep, and this is really important, keep investors on the sidelines for several years. So the property market, if it's going to go up, is not going to be driven higher by property investors. It's going to be owner-occupiers. Now, I have a problem with this. The amount of debt in the system is so high, I'm not sure that there's enough ammunition here to see prices a lot higher, but we'll see. Interesting that that's what the Fin Review says, and that's how they interpret the RBA. Now, just on a few other matters, it's worth noting that the superannuation withdrawals were down again, very small number now. Very significant stimulus, though. It's 34.3 billion gone into the system over the the last few months. But this is coming to an end of its useful life now, I think. And so I expect to see this continuing to peter out ahead. And SQM published some data today that highlighted the more complete picture on auction clearance rates. There were crazy claims earlier in the week. In fact, I discussed this with Edwin yesterday, that the clearance rates were way higher. Well, not sure that's true. 55% is what Sydney looks like, 31% in Melbourne, and the volume is still quite low. So I think the SQM guys have a better handle on what's really going on than some of the other players who are obviously spruiking. Now, with regard to consumer sentiment, this is really important. Westpac came out with their consumer sentiment index and claimed a massive rebound. In fact, they went to town saying, whoa, whoopee, it's all going to go really well now. Everyone's going to buy houses, everyone's going to buy big goods, etc., etc. There was some scepticism, I have to say, amongst a number of our commentators about this one. And in fact, today, ANZ Roy Morgan came out with, I think, a more accurate read based on their confidence, up 0.4%, and they said it's building on momentum from the budget, confidence gain for the 7th week, and there's further easing of restrictions could support the index this week. But it's still in negative territory. It's still close to GFC level. So that's a probably more accurate view of what's really going on. I do believe that the Westpac one was a bit of an outlier, and I'll be interested to see whether next time they correct it or whether it goes in the same direction. I'm really quite worried by this particular piece of information, the way that this information was spruiked all over the place. ANZ, Roy Morgan, I think, provides a better lens on what's going on. Now, my own confidence index, which is updated literally today based on the information from our household surveys, is actually slightly improved. So it went up to 78.07. Now, that's higher than the ultimate low of 73.2 once that was when COVID hit, but it's still well below the 100, which is the sort of the neutral setting. And in fact, what's interesting that if you start looking at the details of this, what you see quite soon is that the affluent households, those with market investments particularly, are doing quite well at the moment because they're actually moving up quite strongly. So their confidence levels are still in negative territory, but less so than previously. Those who are renting are down a bit, and that's because there's still a lot of people who are struggling with rents. They've still got back rents to pay, despite the fact that the rental moratoriums are now ending. And in fact, in some cases, we now know that they are being served with notices to quit, even if the official position is that they can't do that yet. Some people are being served. And so renters are struggling. They're also, of course, finding much more rental property around at cheaper rents, so they can also perhaps find alternatives. And the other point there is that mortgaged households improved just slightly, and that's more to do with the very low rates that are now available. A lot of people are still refinancing to lower rates, and that's helping affordability. But overall, it's the affluent end of the market who's benefiting from all of these low rates and benefiting from all of the liquidity pumping that's going on. Now, if you look across age bands, the 20 to 30-year-olds, which are the most significant young group in our survey, is down again. And that includes people who are renting and people who are in owner-occupied mortgages, as well as other situations. Of course, the work situation for many young people is very, very dire at the moment, with less hours, more part-time work or no work. And so that's one of the main reasons why the overall sentiment is pretty low. It actually improves. The 30 to 40 are slightly up, but still in quite deeply negative territory. The 40 to 50 slightly improved. There you've got more affluent households, lower mortgages, so perhaps that's part of the reason for that. And these 50 to 60-year-olds, again, where they've got smaller mortgages and more market investments, they're doing quite well, explains some of that improvement. The 60-plus group is still struggling. They're struggling because savings are being eroded, almost no returns now, and many of them still have mortgages to pay, despite the fact their income is being compressed. And the overall index sort of sits across the various age bands. Now, by state, what's interesting here is that if you look at New South Wales, it's just up slightly, still in negative territory around 80. Victoria is dropping considerably. So the prospect of opening up and the prospect of things coming more normal has yet to work through in terms of real confidence from a financial perspective. People haven't really returned to work yet. Their jobs are still very much in doubt. Whereas if you look at Queensland, that's pretty much sitting where New South Wales is. South Australia is improving, but still below Queensland and New South Wales. And Western Australia is going through the roof. Well, comparatively, it's pretty much caught up now to where New South Wales is. And I think Western Australia is showing a little bit of an improvement relative to everybody else. And some would say that WA is motoring quite firmly. In fact, there was some debate about whether WA should succeed and just create its own currency and just go off on its own. It's closer to Asia than the rest of Australia. So interesting thought. I'm not sure it's totally serious, but with the border shut, who knows? Now, talking about the property perspective, what's interesting there is that the owner-occupier active, those people with mortgages, are actually improving slightly, as I've said. The property active investors, these are property investors with investment properties, continuing to degrade. And that's very interesting to understand. Firstly, because rental returns are continuing to drop, and in fact vacancy rates are rising in many areas. And then the other point is that capital gains that people were expecting aren't coming through. So that means that it's more difficult for property investors to make any sense at all of property investing. I refer back to what the Reserve Bank said about the property investors being silent for some time. What's happening as a result of that is that many are now determined to sell. And I'm seeing stronger listings. And in fact, Cookie Boy put some stats up quite recently on Twitter. Go have a look. That shows that maybe things are a bit stronger than they were. And indeed, in some postcodes, we are seeing massive listings. So I was looking at a postcode today where, in fact, half of the listings are now within the last 30 days. So that's very, very unusual. A lot of the postcodes close into the major centres where there's a lot of rental property, a lot of property investors struggling, is where a lot of the listings are coming from. And just to sort of round that out, the property inactive are still there, somewhere sitting in the middle. Of course, they will be renting or they'll be living with parents. Now, in terms of job security, it's still a significant issue. Now moving into the sort of component parts of the index. And there's a slight uptick of people feeling more secure than a year ago, but that still is the exception. You've got a massive number who are feeling less secure than a year ago with regard to their employment prospects. And those about the same at around 30%, pretty much where they've been. And significantly, ABS reported today that the payroll jobs data fell 0.9% across the fortnight to the 3rd of October. That is going in the wrong direction. That's very significant. The ABS high-frequency data said that payroll jobs remained at 4.1% below their pre-COVID mid-March level, and total wages remained 3.3% lower. But what's significant about the data there is that if you look to the one on the left, you can see that the payroll index and the wages index are falling. The one in the middle shows that it's small firms, those with under 20 employees, that are actually the most significantly impacted by this. And we're seeing that in my surveys too. It's small businesses, the SMEs, are really being screwed very hard by what's happened. It's very hard for them to be able to make it all work, whereas some of the larger firms are a little bit more able to manage through. And the third slide there on the right is just highlighting the fact that there's a divergence between Victoria and the rest of Australia. The fact of the matter is that Victoria is still languishing relative to everybody else, and I do expect to see some recovery there later as the lockdown is eased, but it's going to be a long, slow haul, and in some cases I suspect that businesses are already beyond a point of no return. Now, in terms of incomes, from my surveys, it's showing that the real incomes are falling for well over 60% of households. Slight drop, but only a very slight drop from last month. Those staying the same, pretty much the same. Those who are seeing a rise, there is a small rise, but very small. So most people's incomes in real terms still going backwards. And the cost pressures continue to build as well. You can see there that pretty much everybody's saying that compared with last year, my costs of living are rising. And that's partly perhaps because of spending more time at home, so the electricity bill is bigger, or just food costs, or health costs, all those things. almost nobody has said that their cost of living have fallen over the last 12 months. And a few have said little change, but the bulk of households are saying the cost of living are rising. And so there is an argument here that the official CPI is just way too low relative to what's really going on. And the real truth is that for many people, the cost of living are way above what the CPI is reporting at the moment. It's an interesting debate about whether that's a true indication of inflation or not, as I've discussed previously, and probably in another show we'll come back and talk again about inflation or deflation, because it's a pretty important conversation, frankly. And the pressure from debt remains high. So this particular slide here shows you how people are feeling about their debt. A lot of people are still quite concerned. You can see there that more than 60% of households are less comfortable than a year ago. There's a small amount of an uptick there with people feeling a little more comfortable simply because of the fact that rates are lower and that perhaps they're back at work. And there's about 30% that say it's about the same as it was previously. But savings are quite interesting because whilst there's a little bit of an uptick in terms of people feeling more comfortable, a lot of people are saving. The savings ratio, of course, was a lot higher thanks to the super withdrawal and the JobKeeper and JobSeeker payments. But nevertheless, a lot of people are still saying they're less comfortable than a year ago. A lot of that is to do with the low returns on savings, and there's more than 3 million households who are absolutely locked in to low savings or no returns on their savings. And the proportion who feel about the same continues to fall. So savings for me is one of those silent issues that nobody wants to talk about, but frankly, it's probably one of the most disgraceful parts of this whole policy. Reserve Bank taking rates lower, savers being basically taken to the point where there are no returns. And to illustrate that, CBA came out today and cut their deposit rates again. They cut their savings rate, according to CanStar, for the multiple times. CanStar's group executive said, rarely does a week pass without one of the big banks cutting savings rates. This week it was Commonwealth Bank trimming savings rates by 0.05%. The cuts in savings accounts continue to gently roll over savers with hardly a ripple each time, but adding up to a tidal wave. 6 cuts this year from CBA that have almost halved its net bank savings rate from 1.65% down to 0.85%. And across the market, the average cut to regular savings accounts has been 0.56%, with the average rate now at 0.58%. And CanStar did go on to say that savers can avoid being completely wiped out and still get 2% if you are prepared to go for some of the lesser known brands. And of course, some of those lesser known brands still have the government guarantee. But this whole story about savings being basically squashed means that either people are having to switch to higher risk investments, which of course leads to significant risk later, or indeed simply hunker down and start eating into capital. And if you look at what's happened in the UK, for example, where rates have been very low for 10 years, it ends up with savers basically just eating into their capital and reducing their lifestyle and reducing their ability to spend, and that being a dampener on economic consumption. And this is the thing I don't get. The Reserve Bank is so fixated on the lending side of the balance sheet, and their argument is, of course, there are more people borrowing than saving, but no, it's not really true. There's about 3 million people with mortgages, There's just over 3 million with savers. And in fact, it seems to me that savers are just a silent bunch. They're perhaps not so willing and reticent. They're more reticent to actually make a fuss. But frankly, it's almost too late now. I think we should be making more of a fuss there if we're savers, because we're being crunched again. And if negative rates were to come in, there's a risk potentially later. Some people might even end up having to pay to hold money in the bank. So that's not a good move either. But there you go. The Reserve Bank is just thinking about debt all the time. And the net worth, just to finalise my surveys here, is up. So interestingly, that thanks to particularly the market movements, market investments are higher than they were this time last month. The overall trend is a little higher. But you can see there that despite that, the majority of people, compared with a year ago, are still saying that their net worth is lower, and that's because in many places house prices have fallen and the market value of some investments have actually fallen as well, depending on, of course, what you went for. Now, just more broadly, there were some really interesting news points today. The first one was this one from Bretton Woods that came out. This is from the IMF, talking about a new Bretton Woods moment. And basically what the argument is that after the last reconstruction, which was after the Second World War, Bretton Woods marked a very significant change and focus, and they're arguing they should be doing the same now. And it's interesting that they called out the right economic policies, in other words, prudent macroeconomic policies. Policies must be for people, they said, which means that we should be thinking about those disadvantaged and those in emerging countries. And interesting that they put climate change as the third element in the mix. I think that's quite interesting. But unfortunately, there was no discussion about what I think are the two critical questions to be asking. The first question to be asked is simply this: how can we continue to grow when in fact we haven't a planet big enough to support us? We actually need to understand that we can't go on growing indefinitely, so maybe that touches into climate change. But the second is debt. This massive quantum of debt that's being created, all of this massive liquidity which is being pumped into the system by the central banks, is creating massive pressures. And I don't think at the moment any of the policies from any of these central organisations, be it the IMF or the OECD, are actually on the right side here. And in fact, if you put that alongside the Basel for International Settlements and the central bank as banker, they're all on the same side here. They're all pushing the same liquidity argument and somehow doing the same again with a different outcome. Don't think so. They're going to put more liquidity into the system and we're going to get the same outcome. And unfortunately, that means that I think in many cases, we're going to see negativity for most of the population around the world. Okay, the 1% will do well, but not everybody else. And just to sort of continue that conversation slightly further, it's also worth just making the point here that the housing bubble is also very much still in vogue. The UBS data that came out showed that Sydney home prices are still higher than last year, and they're talking about basically a risk to house prices in Sydney because of rising unemployment. Interestingly, a lot of the local spruikers tried to rubbish this and said, no, they don't understand. Sydney is different or Australia is different. Interesting, though, that the question of overvaluation of property, of course, continues to rage, very much stoked by this very significant debt pumping that's going on. And remember this, and this is a very important chart from Bloomberg to show that the economic activity index for both the US and for Europe are way down from pre-COVID. So both charts track essentially the long-term average and then what happened after the virus hit. And you can see that in both cases, the economies are still performing below where they were, and the rate of increase of performance back towards where they were is slowing. And indeed, many of the international organisations that report on these things are now suggesting that the recovery will be lower and longer, not least, of course, because the virus is still raging, that there are lockdowns now in a number of European countries, including Wales, interestingly. And, of course, it's still raging in the US despite what is going on there. They're still not doing much to try and tackle it. So I think we're going to see this as a long, slow grind. And unfortunately, the indicators here show that I think pretty much around the world, economies are still underperforming. Interestingly, though, China reported quite a significant increase, up 0.7% growth from the start of the year. So they've really started to come back a bit of a storm. Although if you look carefully at some of the things they're doing, it's a bit abnormal and probably won't be able to continue into the future. And finally, I just want to talk about trickle-down because I had a few people ask about this prior to the show and just wanted to explain when I use trickle-down what I'm talking about. So trickle-down says that the benefits from tax cuts and capital gains and dividends and even looser regulation on corporations and wealthy individuals would eventually flow down to benefit middle and low income earners. And the extra wealth accruing from the deductions would drive the wealthy to invest in or expand businesses, boosting economic growth. So that's the fundamental principle. That, of course, is precisely the principle that has been on behind the budget that we've just discussed a few times over the last few days on our shows. Trickle down is not necessarily that smart, though. There's a thing called the Laffer curve, which basically says what you need to do is to reduce taxes a certain amount so that effectively you get more investment. But of course, there is a point beyond which you cannot go and still that happen, because essentially if you take tax rates too far down, then you actually start reducing income again. Now, these Laffer curves were very much in vogue at the time of Reagan and a few other in times in recent history, but they are probably really unhelpful. And you can argue, I think, trickle-down doesn't work because cutting taxes for the wealthy does not necessarily translate to increased rates of employment, consumer spending, and government revenues in the long term. Might give a little boost, but nothing much. Secondly, instead, if you cut tax for middle and low income earners, that does drive economic growth through what's called trickle-up. In other words, it turns the whole thing around, right? Because if you give them money, they will spend it. They will actually then drive the economy harder. But trickle down, not necessarily so. In fact, many people will just prefer to save it. And the added income for the wealthy resulting from tax cuts will simply increase the growing income inequality between the 1% and everybody else. And so we are in the situation where the 1% is winning and everybody else isn't. And trickle down is part of that. So I hope that explains a little bit about trickle down and why I think it's a bad idea. It's bandied around quite a lot, but that's essentially what it's about. Now, just to summarise our scenarios, no change. I did talk about this the other day. We haven't updated. We'll update it again with more information at the end of October. But you can see there that there is still a path to price rises, but it's a relatively small proportion of the probabilities. Most of the probabilities are looking at falls. And I'm sort of sitting that my longer term crunch scenario is probably where it's going to be, somewhere between price falls of 10 to 30% over 3 years. So that's still my base case. Okay, so with that, bit of introduction there. Hope that's been useful in terms of just setting the context. Happy now to have a bit of a go and look at some of the questions that you've been asking and try and answer some of the questions we may have. I do have my postcode tool online. I might just actually show that now, seeing as it's there. So this is our postcode tool. So if you're interested in a particular information about a particular postcode, I can also provide that information as I have it online available. So let's see what we have in terms of issues to talk about tonight. Okay, so Neil O says, when will your next video with John Adams be released? Well, I'm actually recording a show with John tomorrow evening, and we're going to be looking at the big question of, given the size of the debt, the 1.1 trillion or probably closer to 1.7 trillion over a few years, what are the options available to repay it, and what parallels can we draw from what happened after the Second World War, when of course we had a lot of debt that we had to pay back. So that is what I think we're going to talk about. There's probably another show coming, or maybe there's 2 or 3 shows on that, and then we're going to hopefully then come back to this question of inflation, deflation, because John and I are on opposite sides of the fence on this at the moment, so we hope to explore that a bit further and take that information into a next level of discussion. But as I say, the first show, recording tomorrow evening, so probably up Thursday or maybe Friday, will be relating specifically to the question of how do we pay the debt. And just to be clear, I'm now watching the chat for those who thought I wasn't earlier on. Rosie, I've spoken about the Bretton Woods movement on the global currency reset. Now that's an aspect of it. I personally am of the view that this is overdone at the moment. There are a number of people claiming that we're about to sort of see a massive reset on the currency. What that will be it be a digital currency, and who will control it? I'm not sure that we're quite as close as some would be arguing for that. There is clear risk that could happen, and the fact that they mentioned the Bretton Woods, sort of structure, and they want to try and sort of kickstart some things, suggests that might well be on the table. But I don't have enough evidence to say that for sure that it is yet. But I'll be watching that. somebody's there mentioned the central bank digital currency. There was a show last week that I did with Nuggets News to talk about specifically the central bank digital currency, what it means, how it is actually being set up potentially, what the alternatives are with regard to stable coins, all of those things. So if you want more information on that, go and look at last week's show. Okay, Public Servant says, do you expect residential properties on the south coast to fall over the next year? Well, depends where on the south coast you're looking. Let me put up this one. This is actually Wollongong, and I can show you my thoughts with regard to Wollongong. Okay, so here we have Wollongong, and you can see that basically that in my best scenario, which is the blue line, I'm basically saying that there could be a fall of less than 3 or 4%, or 4.7% over 3 years. That's basically saying if everything goes really well with the virus, the economy reopens, the international borders open, the virus gets fixed in many other countries, and we get all our tourists back. Question is that likely? If not, my mid case, which is the one I think is more likely, still sees falls in many of the South Coast postcodes. In Wollongong, it's down 16%. And the worst case, if the virus really does come back and is really forcing more lockdowns on parts of the economy again, we could be down at 29%. So those are my scenarios for one South Coast postcode. I'm happy to look at others if you're interested in particular ones. Just let me know which ones. Okay, what else have we got to talk about? Okay, Otto says, would you suggest putting substantial deposits to leave one of the big four? Well, I assume you mean deposit accounts, right? So the CanStar makes the point that you can get better returns on some of the smaller players relative to the big four. And that's absolutely right. I've looked at a number of the credit unions and building societies. You can get better rates, better service, and they're probably also less risky because they don't actually leverage so much with derivatives, nor indeed have such narrow capital buffers and things. So some of those could well be better. Remember, of course, the deposit insurance scheme goes up to 250k, so you probably want to spread your risks above 250k per brand. And what I mean by that is, if you had money in St George and Westpac and you had more than 250k in both, then actually as one brand you'd be over the limit. So it's worth just bearing in mind. Remember that 250k guarantee is only there once a bank has failed. It needs to be activated by the government, so it doesn't exist at the moment. And although it's spruiked by politicians and banks to high heaven, and it probably will be fine if it was ever needed, it doesn't exist at the moment. With regard to the big four, my own view is at the moment all that liquidity that's been pumped in by the Reserve Bank, all those very low rates, means that the major banks are actually probably in a more stable position than they were even 6 months ago. They can get funding that's much cheaper. They're actually now less reliant on international funding, particularly from bonds overseas. And given that reduces exchange rate risk and also interest rate risk, I think the liquidity of the banks are there. By the way, they've got way more money in their coffers to lend than demand. And in fact, I've made a show or two on this already. Demand is the question. There is very little demand from some areas for lending. And of course, they're also still tightening some of their lending standards. So some have redialed back the loan-to-value ratios for some types of customers in some locations. Some are actually looking at particular postcodes and actually not lending as much or at all to some postcodes. So what's happening at the moment is the banks have money to lend, plenty of money. They're not really that willing to lend, and they're very unwilling to lend to many businesses, despite the hype about lending to businesses. And of course, there was that government-funded business scheme, support scheme, hardly taken up at all. Not surprising because of some of the hurdles that were required. So at the moment, net, I don't think that the banks are looking that wobbly. And of course, if home prices stay up, which means that the liquidity is also protected in terms of not having to hold more capital for their mortgages, then they'll just be wanting to lend more and more and more. And they'll try and turn the handle on a bit further and just grow property prices and grow mortgages and grow property prices. Trouble is, of course, that total growth of credit is falling. It's about 2% now, which is as low as it's been. And as I quite often say, and I'll say it again, it's the rate of change of credit growth, which is the most significant determiner of home prices with the rate of change declining. That's more of an indication of lower prices ahead rather than higher prices, but with some variations, of course. In some areas, prices may go higher. So Otter says, what I see with your forward modelling is that it's got a few years to run probably in the USA. It's an economic and even summer down under. Well, depends, you see. So much of our economy is predicated on what happens internationally. We've got the China connection, of course, and the China relationships are not looking that flash at the moment. We've also got the iron ore situation, and interestingly, data came out from Vale today. That's the the Brazilian ore basis, basically increasing exports to China. So in fact, we're competing now with some of the Vale exports. So the China connection is the first one. The second one is, of course, we're very reliant on tourism and we're very reliant on students. Both of those are locked out at the moment. Now, that may turn around, but the chances of getting students from some places in Europe or in the US is pretty low. China possibly, if China will allow students to come back. But then China's been bad-mouthing Australia with regard to its education system and all sorts of things. So that may not be very strong. And the third point is that a lot of the things that we've been reliant on in terms of actually driving the economy is also now looking as though it's coming to the end of its natural life a bit. So the question is, where's the growth engine, right? So yeah, Indian summer, not sure. It looks to me as though there will be some local momentum created. If the borders get open locally and people can travel between states, that's a good thing. And I know that in the Northern Territory they're booked out for Christmas, for example, and places like that. But frankly, that's going to pale into insignificance against those international flows, which are going to be very significant. And of course, as I said, the US, Europe are both struggling with the virus, as well as many other countries. And the risk, of course, is that we find that the virus pops up again. And if we get another Victorian scenario, we could be locked down again. So I'm afraid that it's looking pretty shaky. That's why my mid case, which is the one that I tend to sort of build most of my modelling from, assumes that the virus is still around. It sort of pops up, but doesn't lock anything down dramatically over the next year or two. That we do get ultimately, we get some sort of a vaccine, and therefore things begin to ease. But it also assumes that the air flights from most countries around the world won't be back to normal for at least 2 years or so, and most of the airlines are now planning on that. And that Europe and the US continue to struggle with the virus for quite a lot longer. So effectively, the international economy is disrupted for quite some time. And interestingly, as I showed you earlier on, the trends in terms of growth is much lower than it was before the virus. And most of the analysts that I'm reading are still suggesting the growth will be lower for some time ahead. Although, interestingly, I did have one or two people say, see, China did a V-shaped recovery. Well, if you look carefully, it's sort of engineered V-shape, but it's not quite what it was. So watch for consumers and what they're going to do ahead in China. Okay. What else have we got? 2126, somebody's asked about. 2126. Okay, let's do that, shall we? Quite like the old postcode. Right, let's flick that into there. Okay, so 2126, which is Cherrybook. And there we've got 6,100 households, 3,300 borrowing, 1,300 renting, just under 1,000 properties to rent, and we've got 2,200 property investors in the postcode. The overall financial stress measure is at 47%. That's sort of just above average, so that suggests there's a bit of pressure. And in fact, you can see that the pressure is partly from homeowners with mortgages. 33% have mortgage stress. That's lower than the national average at 39.5%. Not too bad. But look at this, rental stress, 72%. More than 940 people have difficulty with paying their rents. And that's putting pressure on the investors too. So 45% of investors are struggling. That's higher than the national average. Nationally, it's around 25% of investors. So this is a postcode where I believe the primary areas initially will be in the investment part of the conversation. We know that a number of people are considering potentially selling, getting out while they can. releasing equity. And in fact, my mid scenario here shows that effectively prices are expected to flow down a little. And indeed, if you actually follow the best case scenario, it's still down a little, not dramatically, but down a little. So I think the reason is this. I'd also watch for the mortgage stress stuff, because we know that there are a number of people on mortgage stress at the moment who've got also principal and interest payment holidays. And we know that some of those are going to actually change ahead as the banks restructure. And as we move forward, I wouldn't be surprised to see some of those having to settle too. So quite a lot of forced pressure. And because of this rental stress, property investors are really going to find it quite difficult, I think. Otto says, yes, you made my point. I believe from my pandemic modelling, the virus will preclude the global economy disrupted over the next few years. All local flows will be dwarfed. Yeah, I agree. Yeah, I think you're absolutely right, Otto. The fact of the matter is that until we are actually in a completely different mode, this is going to continue, right? And what I'm concerned about is a lot of people are sort of hankering back for how things were before the virus, rather than actually saying, well, actually, maybe this is an opportunity to lay some foundations for something different ahead. So there you go. That's how I think about it. Another postcode. Somebody's asked for another postcode. 3370. Sure. Easy to do. These tools will be online soon. We're just doing some more work. We keep finding new things we can add and better sophistication in terms of the way the model works. So once we've got it sorted out, then we'll make the postcode tool available online. It's updated each month, of course. Okay, so this is 3370, and this is a place called Clunes. Didn't know about Clunes in a regional Australia, obviously in Victoria. Very small postcode, actually, 929 households. A third borrowing, a third renting, a third of properties just under properties to rent, and not many property investors. Financial stress metric at 52%, and this is because we've got mortgage stress around 40%, so that's pretty much at or slightly above the national average. Risk of default, about 2%, but look at this rental stress, significant rental stress in the area, so a lot of people are beginning to struggle with making those mortgage repayments. Investors, not so bad. So it's a rental stress story. And as a result of that, my best case is a fall of prices of 10% and then a slight increase, but effectively 10.2% in year 3. My mid case, which is the one I base my prices off, it's looking more like a 18% fall over the first 12 months. That's on average. Units probably will follow that. Houses probably less so. One of the things we're going to be introducing into this model ahead is the differentiation between houses and units. So that will help to provide further clarity. So that's the story there. Mortgage stress, high, rental stress to the moon. And I had another request for 2152. Let's put that one in there. Okay, 2152 is Northmead. 4,700 households in the postcode, 1,900 borrowing, 2,100 renting, 1,600 properties for rent, and 1,700 property investors, 55% in financial stress overall, 33% in mortgage stress, so that's below the national average in terms of mortgage stress, but 70% in rental stress, and 49% of property investors, including some investors who are in severe stress. That's quite significant, actually. The severe stress stuff often, shows that there's a lot of pressure to sell. So quite a lot of pressure to sell coming from this nexus here of investors and renters. That's how I read at the moment. So the best case scenario is a fall of about 3%, 2.6%, and 4.9%. Mid case of 11, 14, and 16. Okay, now let's think, what else have we got? Lots of other postcodes. Lots of postcodes. 2800. Wait for that to come up. There you go, 2800. So this is Orange, Spring Hill, Mulling Creek, 19,000 households, 7,200 borrowing, 8,500 renting, 6,500 properties for rent, 4,100 investment, and 52% financial stress, 73% in mortgage stress. So mortgage stress, big deal here. That's why the default rates are at 3% rather than something lower. And rental stress is quite high at 48%. Investors not so badly hit. I should make the point that some of these investors won't necessarily have properties in this particular postcode. This is where they live, just to be clear. So this is a mortgage stress story. And as I said earlier on, quite a few people are struggling with these with these interest and principal holidays. And the fact of the matter is that I think ahead it's likely that some of them will have difficulties as the banks bear down on them. So that's part of the reason why I believe there will be further falls ahead. And you can see that the mid case is 10, 13 and 16 over the next 3 years. Okay, that's 2480. Did I do 2480? No, I lose track. So many. No, I didn't. Okay, so this is in New South Wales, 2480. Lismore, Richmond Hill, and a few other places too. 19,700 households, 7,000 borrowing, 8,000 renting, 6,400 properties for rent, and 7,700 investors. Financial stress at 37%, so that's a bit lower than we saw. Mortgage stress, very low, not a big issue. Rental stress, 63%, that's a bit higher. 63% is, significant. Anything above 35 to 40 for rental stress, I get worried. And investors at 34%. But you can see there that this is suggesting that in the best case scenario, prices may actually rise over the next year or so. My mid case is slightly less positive, going into negative territory at 13.9% in my mid case over 3 years. Okay, so that's that one. Done that one, I think. 337. Oh, yes, I did Clunes. I'm jumped through. Can I do 2121? 31. 3121. 3121. Yeah, sure. There you go. So this is Richmond in Victoria, 15,800 households, 4,000 borrowing, 10,000 renting, 7,800 for rent, and 4,600 investors, 47% financial stress, that's the overall financial stress measure, 42% in mortgage stress at 1,600, 38% in rental stress, and 42% of investors in investor stress. So it's pretty much spread. Overall stress, is enough to be concerning, and you'd expect perhaps to see some properties coming through. The best case is down 8% over the next year, up slightly to 6.9, and then down again to 8.2 over 3 years for Richmond. Okay, what else? Somebody's asked about 6163. 6163, right. 1163. Here we go. So that's Western Australia, North Coogee, North Lake, O'Connor, Sampson, Spearwood, Barbara Lakes. Okay, 22,800 households there, 9,000 borrowing, 9,000 renting, 7,000 properties for rent, 8,000 investors in the area, 52% financial stress. Mild stress at 4,900 is 54%, that's quite high. 4% defaults. We're seeing quite a few defaults in Western Australia because this is something that's been going on for quite some time, all of this default stuff. And the pressure builds, and that ultimately leads to a high level of default. Rental stress at 48%, property investors at 31%. So rental stress, mortgage stress is where the action is in Western Australia. And by the way, many Western Australian postcodes are still seeing very high levels of mortgage stress, despite the fact that in some cases we are seeing more activity in homeland packages thanks to the various incentives that were put in place. But of course, homeland packages have a very significant negative impact on the rest of the area. So people tend to prefer new rather than old. So old properties in the same area tend to go down in value. Quite a few of them hang fire. And it's interesting that, a lot of the spruikers are saying, hey, whoopee, WA is really booming now. Not necessarily. There are some areas where prices, particularly for houses, are up. Units, not so much. And on the sort of spread north and south up the coast and down the coast, there's still a lot of negativity, still a lot of significant falls. Remember, prices are way down, so more than 20% down from where they were 4 or 5 years ago. Many people still in negative equity, many people struggling to know what to do with the situation there. So it's not too surprising that the fact of the matter is, Western Australia a little stronger, but probably not necessarily as strong as the spruikers would have you believe. Now, Ben asked an interesting question. What do you think corporations and franchise owners, new car dealers, service stations, retail stores, fast food? Well, my surveys are telling a very poor story here. So retail is particularly troublesome. A lot of franchise people dealing with cars are actually, particularly second-hand cars and particularly new cars, are struggling. And we're seeing quite a lot of negative momentum. So I mentioned earlier on that in my surveys, some of the smaller households, some of the small businesses are actually struggling. Some of the bigger ones doing a little better. So if you're part of a big chain, you might do better. But retail is looking pretty sick at the moment, frankly. And I continue to see lots of vacant properties that were particularly businesses previously. And the fact of the matter is we're starting to see that now spread into some of the larger malls. And I noticed that some of the rents there are being cut at the moment to try and keep people in the malls, but the throughput's still quite low. So I think that some of these are going to be finding it quite difficult ahead. Somebody asked, is this a website? I don't know. Don't understand the question. Okay. We might just silence that one. Yes. What else? Okay. Now, sorry about the spam there. We just had a little incident, but what can you do? 2077, somebody asked. 2077. Yeah, let's go there. Okay. So this is Hornsby Height. 15,000 households, 6,000 borrowing, 6,800 renting, 5,200 for rent, and 60% in financial stress. We have 34% in mortgage stress. That's 888 in severe stress. That's quite significant. And default rates at 4%. Seeing quite a lot of this in some of the New South Wales areas, particularly north and south of Sydney, like Hornsby, that I think is quite significant. And I expect the default rates to rise quite considerably. Rental stress 49%, investor stress 59%. So you can see that overall, the mortgage stress is an issue, but some of the rental stress is an issue too. So that's one of the reasons why I think it could go the way it is. Okay, now what else have I got here? Okay. 4551. 4551. 4551. Let's do that one, shall we? Aruna, Battery Hill, Moffat Beach, Pelican Waters, Shelley Beach. It's amazing, the more I do these, the more places I discover. It's some lovely names across Australia. 26,600 households, 8,500 borrowing, 12,000 renting, 9,000 properties for rent, 7,800 investors at 42% in financial stress, 36% in mortgage stress at 3% default, 49% in rental stress, that's 5,900, and 31% in investor stress. And you can see there that in Queensland and here, my best case is prices could rise over the next 12 months, 2.5% in 24 months, and then a slight fall. My mid case, which is most likely, is a small fall, 5%, 9%, and 13% over the next 3 years. Okay, let's have a look. What else I've got? I'm interested. Can you talk about how your surveys work? How often? How many people are there by phone? Yeah, all right, let me talk about the surveys for a bit. So as I explained earlier on, we have this revolving survey. It's actually 1,000 households each week, and it's done over the phone. I don't make the phone calls. I design the survey. We employ one of the big research companies to make the phone calls. They have the statistical models and lists of people that they can call to make sure that we have a statistically robust and accurate set. So we get 1,000 coming in each week, comes in on a Tuesday, put them into the model, and I drop off the oldest 1,000. I've always got 52,000 in the sample at any one time. 52,000 is 0.5% of the population in Australia. So that's a statistically robust sample. And what that means is that if we have a population distribution mirroring the census, which we do, that means that we get pretty accurate data for a lot of the postcodes with bigger counts of households. Very small counts of households may not, in particular postcodes, might not be quite accurate, so I'm always a bit cautious about those. But the big ones, it's pretty good. The survey lasts about 12 minutes. We ask a series of what's called branching questions. So we don't ask all the questions every time. And it basically, if they've got a mortgage, we ask some questions about the mortgage. If they've got a credit card, the same. If they haven't got either, then we don't follow that down that branch. And we try to get information about their profile, a little bit of information about their financial footprint, so we can make an assessment of their cash flow, money in, money out, those sort of things, and also their buying and selling intentions. So the survey has some qualitative data as well as quantitative data, and all that sits in the surveys. These have been running since 2002, so we've got a bit of history, and that means we can go back and track things. Sometimes we do for clients. That's how the surveys work. Okay, let's have a look. Somebody's there. W. Butters says WA's whole economy is reliant upon China's hunger for ore. If that slows down or dries up, it could be big trouble. I think that's true. I mentioned Vale earlier on, right? And the latest statistics show that, in fact, the share of iron ore going to China from Vale relative to Australia has actually moved up. So there could well be a little bit of a switcheroo going on. Obviously, the iron ore price is very strong at the moment because China is frantically taking iron ore and then trying to use it to create growth in its various economies. The question is, how long will that continue? Will Brazil continue to increase its output? And if it does, what's that going to do? And I guess the other question is, what's going to happen to the exchange rate? Because obviously the exchange rate impacts the income that comes back or not. Mate in WA says, house knocked down over and 7 to be built. Apparently, many already sold, have not even started building yet. Yeah, that's true. There's a lot of subdivisions going on there. There's a lot of stuff on very, very small plots. The average land size has dropped from sort of 600 down to 250, 280, 300. The question is, who's buying them? Why are they buying them? And will they regret buying them later? Remembering, of course, that when you buy new, particularly off the plan new, you're locking yourself into a particular price now. You've no idea whether the price will be higher or lower later. Typically, what you discover is that a new property loses value once you move in, and particularly if you're buying one of a number of properties all the same, then there's no unique value to it. So I'm quite concerned about this sort of concentration and subdivision process. By the way, subdivision is something which is massive in many different parts of the country at the moment. It's huge. The planning regulations have been really loosened to allow people to do this. Remember, we've got 1.2 million spare properties across Australia. We've got a reduction in migration. The budget said negative migration for at least 2 years, less demand. So with all that supply already there, with more supply coming on, now explain to me why prices will go higher. I'm not as convinced as some. 2077 somebody asked for. Let's give that one a go. Did I do that one? Hornsby. Done that one. Tick. Okay. Okay. 2150. Did I do that one? Let's have a look. That's Parramatta and Harris Park. No, I didn't. Okay. Put the screen up. Okay. So 12,700 households. 2,400 borrowing, 9,700 renting. This is a rental story, I think you'll find. 7,300 properties for rent, 4,900 investors, 77% in rental and financial stress. Mortgage stress at 29%, that's quite low. 2% defaults, but look at this, rental stress. 70% of people with rents in that postcode are actually struggling. 6,850. And we've got investors also struggling at 66%. 1,000 of whom have severe stress, 2,227 total. So this is an interesting example. A lot of it is to do with the unit constructions in the area. Massive numbers of units were constructed, massive number of investors piled in, and a massive number of tenants piled in as well. And they're really struggling. So this is one of the reasons why prices in this particular area are looking as though they could fall by, in my mid case, 12%, 15%, and 70% over 3 years, and even my best case, small falls. Okay, what else have we got? $2,077. Can do that. I've done that one. Somebody's asking for the same one again. Okay. Adamstown 2289. Haven't done that one. So I apologise if I do the same one twice, but there you go. Adamstown, New South Wales. 7,800 households, 3,500 borrowing, 2,500 renting, 1,900 properties for rent, 2,600 investors, 34% financial stress. So that's one of the lower ones. 39% in mortgage stress, 1,400, 30% in rental stress, 770, and 19% in investor stress, although a few are stressed seriously. So less severe than many, and you can see the result of that. Prices could be higher over the next 3 years. Not dramatically, just up a little bit, whereas the mid case is small falls. So the quantum of the falls up or down is quite often driven by some of the stress metrics. It's not the only thing, but it's one of the critical ones to look at. Okay, what's that one there? 2770. Okay, Bidwell, Blackett, Minchinbury. A few, I have to say that some of the places here I haven't heard of, but it's the other side of Blacktown, so that tells you something. Okay, that could be quite interesting. So 20,000 households, 6,700 borrowing, 11,909, 12,000 renting, 9,000 property rentals, and 7,800 investors, 81% in financial stress. That's very high. And this is significant. Look at this. 80% in mortgage stress. So we're seeing this in a lot of those Western Sydney postcodes. A lot of people finding it really difficult to pay those mortgages at the moment. The default rates could be quite high too, but 2% at the moment. So this could well translate to higher defaults later. Depends on how long people are in stress, because what tends to happen is people get into difficulty, hunker down, try and survive, and then later have to do things. 73% of renters, or 8,700 in rental stress, and 51% of investors. So pretty much wherever you look, it's not looking too good. Therefore, even our best case, we're looking at falls of 5 or 6% over the next 3 years. In fact, 7.8% over 3 years. The mid case is down 19.8% over 3 years. I think this is a classic example of a Western Sydney postcode. Okay. All right, what else have we got? 4502, sure. Petrie, 3,300. 1,900 borrowing, 1,100 renting, 883 properties for rent and 539 investors. 22%. This is at the other end of the spectrum, right? A little bit of mortgage stress at 39%, but nothing particularly serious. No real rental stress, no real investor stress, interestingly. And the trajectory is like this. Significant rises potentially over the next 12 months, six, and then a slight fall over the third year out. So, yeah, interesting postcode. I would say that as we move into some of these ones with smaller numbers, some of these numbers move around a little, but the overall stress levels is pretty low there. Okay. Okay. Now let's have a look here. 3226. Does the mortgage stress percentage delve deeper to say how stressed they are? 3226. Yeah, I'll talk about that. Thanks for that RR. Ocean Grove. So when we come to the mortgage stress one, so let's go 7,300, 2,600, 3,300, 2,500, and renting 1,789. Financial stress 23, so that's quite low. In the mortgage stress one, we have mild mortgage stress. That's somewhere close to zero. In other words, cash flow slightly negative or slightly positive, but very close to zero. We have severe stress. In their severe stress, they're at least 5% underwater, sometimes 10, 15, 20%. And that tends to lead to more significant pain and pressure later. 28% mortgage stress, 18% rental stress, 21% investor stress, pretty low. As a result of that, small falls, but nothing dramatic in my best case scenario. Slightly worse in my mid case at 13, 15, and 17. Thanks for that. Sean asked for 2,444. Let me do that. 2,444, and thanks for your contribution. Appreciate that. Blackman's Point, Port Macquarie, 22,200 households, 6,300 borrowing, 10,000 renting, 7,800 properties for rent. Number of rental property owners, 8,300, 46% in financial stress. And that means that we've got mortgage stress of 30%, or 1,800, rental stress at 55%, or 5,570, and investor stress at 37%, or 2,754. And again, you can see that in the best case scenario, only very small falls. In my mid case, some falls 9, 12, and 15 over 3 years. And Pete, thank you very much for your comment in the chat there. Really appreciate that, and for your contribution. Thanks. He says, thanks, Martin. Very glad I discovered your channel. A great non-mainstream resource. Yep, we try to be. We try to be a little bit balanced, but also trying to be as objective as we can with the information we've got available. It's pretty important, of course. And the fact of the matter is that there isn't much else out there that really goes into the sort of stuff that we go into. There's a lot of channels talking high level on some of this economic stuff, but the granular data that we've got, we think is very valuable, and it really gives a different perspective. And one of the tricks, of course, if you're negotiating with regard to property, is to get granular and really understand what's going locally. Well, this can help. So that's why we think it's pretty important. I'm glad that you find it useful. And Sean, thank you for your contribution there, has asked also for some information. I'll show you that in a second. And your work is invaluable, he says. Sean, I appreciate that. Thank you. That means a lot. Okay, so this is the one you asked for, 2540, which has a whole long list of Sussex Inlet, Swanhaven, yeah, all of those. 25,400 households, 6,300 borrowings, 13,000 renting, 9,800 properties for rent, 9,800 rental property owners, 45% in financial stress. So it's high. I would say some of these postcodes were impacted by the bushfires and some households are still struggling because of it. Mortgage stress doesn't seem to be the main problem. Rental stress, though, is high at 66%. And some property investors are actually getting into difficulty at 46%, 1,900 in severe stress out of a total of 2,586. On a best case scenario, prices hardly move over the next 3 years, down 2.8% over 3 years. But my mid case, longer term crunch, down 9%, 12%, and 14.8% cumulatively speaking over that period. And Shang has said, an interesting question. Thank you for that question. Let me answer that, and thank you for your contribution. Any tips for young investors around 12 to 14 years of age to begin investing their pocket money? Interesting question. Well, now, the thing about investing, right? I think what you should do if you're interested in investing and you're young, you can actually play some of these investing games where you don't put real money in. And you can run shadow investing on, for example, a stock market and see where it goes. Get used to that process. That's where I'd start. I wouldn't put real money in to start with because I think it's quite important to learn the ropes. Remember also, of course, that if you're young, then there are various things that you can and cannot do, contractually speaking, and there are things that you can and cannot buy, contractually speaking. So that's another reason why it'd be hard to trade when you're very young initially. But as I say, play the investing game. There's a number of them around that are actually really good. You can run a shadow. In other words, basically make up a portfolio and just see how it goes, and experiment with it for a year or two and see what. That's what I would do. I did that when I was young. I learned a lot by doing it, and I also learned some of the terminology and some of the tools, and then later, took it further. That's what I would do. That's where I'd start. And Monty13, thank you for your contribution, says, could you please look at 3199? Yeah, I could do that. Also, any advice for us who were planning to keep cash during the deflation downturn if negative or zero interest rates happen? Yeah, well, let's talk about cash first. So, there's an interesting question. What do you do with cash? Now, interestingly, there was a report that came out quite recently that said that the amount of cash in circulation has gone through the roof. In fact, the number of $100 bills printed has never been higher. And there's also speculation that many people are taking money out of the bank, putting it in the safe deposit bank and in deposit box, and then putting it back in the bank again, right? Because if you're getting almost nothing, then it's home and host. Now, I'm not sure I recommend that as a strategy, but and you've got to be a little bit careful on the lien of stuff in a safety deposit box. Just read the terms and conditions and make sure you understand all of that. My own strategy has been to continue to use term deposits for a bit because you can still get reasonable rates, not massively strong rates. Spread the risks, 250k max in any one bank because of this deposit insurance guarantee thing. And basically keep liquid, don't lock yourself into anything that provides too many barriers to getting money out if you need it. My own view is there will be an opportunity for investing later. One of the most difficult things to do at the moment is just to sit on the sidelines and let things go past, right? A lot of people can't sort of countenance that as a strategy, but sometimes doing nothing is a good strategy. So that's what I'll be doing. And I mentioned earlier on, spread the risks. Look at some of the smaller depositors as well. Some of the banks are actually quite small, but they actually offer quite good rates. And CanStar has a very good tool that allows you to find the best rates that are out there. And generally just be a little bit cautious and spread your risks across multiple organisations. Keep below the 250k is what I'd be doing. Now, if zero interest rates come in, interesting question there is how would it come in? So would they actually charge a negative interest rate? It's unlikely. I think probably what they would do would be to say small deposits wouldn't be charged a fee, but larger deposits might be charged a holding fee for holding the money. That's what's happening in Germany and other countries in Europe. So if you're over a certain level of savings, then you have to pay a holding fee to the bank for holding the money in the system. Right? That's the way it works. Now, that's something which could be implemented quite quickly and easily, whereas negative interest rates, in other words, turning the whole banking system on its head, would be complex and difficult. Although, interestingly, in New Zealand, they've alerted the banks there that they should be thinking about it, as has banks in other countries around the world. So we'll see what happens there. The other thing to look at is your terms and conditions. So if you actually are putting money into a bank, do read the latest terms and conditions. There are some pretty worrisome terms and conditions around at the moment. So somebody sent me an ANZ terms and conditions the other day, which basically said, we may not give you your money back when you want it. I mean, they dressed it up, but that's what they said. They're saying, we will apply our judgment. So you're not sure whether you can get all your money back or not, and you're not sure under what circumstances they might actually do that. And, they use the example of, they want to make sure you're not under duress, for example. So, want to make sure that you are withdrawing money freely, all those sorts of things. And that's probably good, but it's also quite broad. So the clauses in the terms and conditions on savings are worth looking at in detail. I know they're boring, but worth reading. But remember that they govern the way that you actually have your money held. Remember this simple fact: a deposit is an unsecured loan to the bank. I'll say that again: a deposit is an unsecured loan to the bank. That means that they hopefully will pay you back, but they may not. They're not holding your money in trust. They're not holding it on your behalf. It's a loan to the bank. That's something just to bear in mind. And I hope that has helped a little bit there, Monty 13. Okay, 2031. 2031. Yes, I know. 203. Yes. I get it. Why don't I do 2031? Okay, let's do that. 2031. Persistence sometimes pays. Or have I done that one already? Let's have a look. Clevelly and Randwick. There you go. Let's put that back up. We're nearly at the end of the show, It's amazing, isn't it? It's funny how we scoot through postcodes. Randwick, 15,400 households, 4,200 borrowing, 9,000 renting, 6,800 properties for rent. Number of rental property owners, 6,200. 68% in financial stress. That's quite high. Within that, 706 in mild stress, more than 1,000 in severe stress. That's a big deal. 43% in mortgage stress. Default rates at 3%. That's quite high. 58% of rentals in rental stress at 5,200, and 67% of investors. So you can see all three legs of the stool there are actually under some duress. Not surprising then. Best case, a fall of 4%, 3%, and 5%, mid case 12%, 15%, and 17%. This is a postcode in difficulty. We're seeing a lot of these inner Sydney postcodes. And note the segment, exclusive professionals. So these are the top end. These are the people with the big mortgages, the multiple investment properties, the big lifestyles, and many of them are actually definitely being caught with less income than they had. We're moving into what I call structural unemployment. And structural unemployment basically means that we're now seeing large jobs going. We're seeing senior executives disappearing out of firms. And that's a big deal because a lot of those are actually the people holding these big properties, multiple portfolios. And we often see they've got struggling with their own mortgage repayment, and then their investment properties have started to not perform because they can't get the rents that they were used to. So it's sort of cascading. And then the banks come knocking and saying, well, you had that interest in principal repayment holiday. That's got to end. How are you going to start repaying? And in some cases, the banks will push them into interest-only loans and those sorts of things, may give them an extra lease on life for a bit. But these are significant times for some of these households and some of these postcodes. Okay, what else? 2765, okay, 2765, we'll do that one. Okay, so this is Berkshire Park and places like that. Let's put that up so you can see it. Vineyard, Marsden Park, 5,400 households, 2,000 borrowing, 2,100 renting, 1,700 for rent, and 1,300 rental property owners. 74% in financial stress. That's big. 90% in mild mortgage stress. 2% default rate, 1,865 in rental stress, 85%, 42% in investors, 353 of which 216 are in severe stress. So this is, again, another classic example of multiple factors all playing the wrong way. Mortgage stress is high, rental stress is high, property investor stress is high, overall very significant, and you can see therefore that this translates into quite significant falls ahead. Mid-case, 15, 18 and 20% over the next 3 years. Thank you, TBA. Now, Rosie asked, interesting question, do I have statewide stress, investor stress and rental stress percentages? I do. I don't have them available now, but if you go to the DFA blog and just do a quick search on mortgage stress, you'll see that I posted the averages for each state a couple of weeks ago. And or you can see the live show that I did 2 weeks ago where I went through that in detail, so that information is available. When the postcode tool is up and available, I will try and include the state level stuff and the next level down as well. For example, people get asking about Gold Coast or Sunshine Coast, right? So I'm going to try and include that level of granularity too. All right, now I'm at 9:27. I have not actually covered all of the ones that people asked. Sorry about that. What I will say is if you want information about a particular postcode, you can send me a message on the DFA blog and give me a day or two to turn it around, but I will actually respond and send you the same chart that I've gone through this evening. I always get more requests than people's, than I've got time to cover them all. The fact of the matter is, that's a way of getting information. So send me a message on the DFA blog and I'll respond that way. Now let me just quickly go back to finalise the rest of the show tonight. And just to say that the next sort of story really is just in terms of what's coming next week. So let me just put this up quickly. I should just say, if you want more information, go to the DFA blog. There's the link there. You can sign up and get all of the alerts for all the stuff we do. You can also support us on Patreon if you'd like to do that. I have a number of people do that. Really appreciate it. And interestingly, there is the opportunity to get all of the stress data each month for $50 a month plus GST. That's sent as a spreadsheet. That includes all the data I've shown tonight for all postcodes across Australia. So I've got quite a few people who take that, sent out about a month after the month end. Or if you want a more detailed conversation about a particular postcode, I'm still doing my DFA one-to-one, where you can actually ask me specific questions about the particular postcode, and I look at things like stress, home price trend data, a view of price trends and all that sort of stuff, and I can discuss it in more detail. I usually do it on Zoom or by phone up to an hour, although typically it's 30 to 40 minutes, and that's $250 plus GST, payable in advance. If you want information about that, send me a message on the DFA blog. As with all of these things, I'll respond as soon as I can. Spaces are limited, booking about 3 to 5 weeks ahead at the moment. But if there's an emergency, if you've got a real dire need, I'll try and help. I do get a few rejigs and cancellations. So, or you can make a contribution if you'd like to help me more generally via PayPal. I have a number of people who do that, and that's always appreciated. There are lots of costs involved in just doing all this stuff. Not out to make a profit, but really just cover some of the costs. My main purpose of doing this is to help people understand more about what's going on and sharing more relevant data. Or there's even a QR code if you're interested in making a Bitcoin contribution. And there's even merch, as I've designed, so you can get that from the YouTube channel or direct from the Teespring. People asked earlier on, do I do merch? I do, a little bit. And the next show is a live Q&A next week on the 27th of October. This is a very important subject. This is about the deposit bail-in. There's legislation in the Senate at the moment which will come up for debate in about a month's time. And so in the next show, I'll have Robbie Barwick joining me from the Citizens Party. We're going to go through the whole argument about deposit bail-in. What does it mean? Why was it introduced? Where is the status of bail-in Australia? And particularly relevant, of course, for those with deposits of any size at the moment. What is the legislation going to do? And what can we do to try and make sure that the legislation is changed so that effectively deposit bail-in is removed from the agenda? So mark your diary for that. This will be a very important show. I personally think the deposit bail-in, although practically it may never happen, theoretically it can happen, and therefore it's something that we need to be very, very clear about. And there are things that we can do to make sure that bail-in never happens in Australia. And if you think that we're just making up bail-in, let me just tell you that in New Zealand there is legislation that allows banks to use bail-in as part of a restructuring. In other words, deposits are converted into equity, and that's a way of keeping a bank going. So it's not just a theoretical discussion. Okay, so there you go. I want to say thank you very much for spending some time with me this evening. I really appreciate all of those who've asked questions. If I haven't got to your question, I do apologise. As with always, way too many questions than time we've got. The fact of the matter is, there's always another show. I'll be back on in a couple of weeks' time with more stress data and more postcode data. Meantime, if you want information on a particular postcode, drop me an email via the DFA blog. There's a little app there. You can just send me a message very easily. And I want to say thank you very much for spending some time with me this evening. I hope you found it useful, and have a good evening. And I'll see you next time. This is Martin North from Digital Finance Analytics, signing off.